Welcome to the Millennial and a Boomer Walk into a Coffee Bar podcast.
The very best podcast to get your life advice in the form of a grande caramel macchiato in a venti cup, 1/3 whole milk, 1/3 almond milk, 1/3 soy milk, double the amount of vanilla syrup, caramel wall in the cup, no caramel drizzle on top, upside down, of course, tall ice cup, whipped cream, rounded lid, one shot extra espresso, decaf, cinnamon sprinkled on the top, and for the name, that's David, spelled Dafydd, please.
Or to get your business, finance, and life support black coffee advice, I'm Dan, I'm a Boomer.
And I'm Chase, the Millennial. Thanks for joining us today.
I'm going to start this off by taking a drink of coffee.
Oh, that sounds like a good plan this week.
And sporting our new Boomer and Millennial BAM logos right on our coffee cups.
And for those of you that are boomers, you'll remember this. Some of you millennials who stayed home from school remember as well. Wheel of Fortune, I'm Vanna Whiting this for those of you watching on YouTube.
It's more like Carol Merrill from The Price is Right, but that's okay. So anyway, welcome to another podcast of a Boomer and a Millennial walk into a coffee bar. Obviously, you're the Millennial and I'm the good-looking Boomer.
That's debatable.
And, you know, I'm especially good looking to those people that are listening to the podcast and not watching it on YouTube. So
what you're telling me is
you can download.
What you're telling me is you have a face for podcasting.
That's right. I do. I could have the big podcasting voice, but I've got the beauty to match, especially when it's not a video. So anyway, here we are again. We've talked about our favorite subject, getting a loan or not getting a loan and things like that in our last episode. But what are we going to talk about today? And do you have an enlightenment joke for us this morning, or depending on whatever hour you're listening to this podcast?
Yeah. I mean, what about Stacy? Stacy's listening in her car as she's driving down the freeway, and it's nighttime for her. So we can't say good morning, even though it might be morning for us.
That's right.
In this world, in the universe, what multiverse in which we live. Oh man, there's some good millennial stuff there. I do think we should start out with a good millennial joke. How many millennials does it take to change a light bulb?
You know, I don't have an answer for that, but I'm sure you do, and I'm sure you'll work in a Boomer somewhere in there.
Yeah, I mean, I don't think anybody knows because the Boomer has the job right now and they can't retire because they never saved anything. And millennials all have LED lights that last longer.
Let me see. You know, the funny thing about you millennials and these LED lights is when they go, you have to buy a whole new fixture. You can't replace them. And so the boomers are one up, but then the incandescent light bulb has been outlawed by the U.S. government, and so we're all converting to LEDs. Can you install light fixtures? That's the simple question, because boomers, for the most part, they can. We've shocked ourselves many a times. Millennials and Gen Zs, can you guys actually replace a light fixture in your house?
So we did actually. I did replace, well, we had two light fixtures and my wife wanted to move this one to this room and get a new one for this room. And so I did that, and I don't know what I've done, but every time, I'm not kidding you, at least twice a month, I'll go in and flip the light on and one of the light bulbs will burn out. I replaced more light bulbs on this thing, on the old fixture in the new place, than I've ever known to have to replace before.
Could you tell your wife you're going to replace the light fixtures with LED lights and a whole new fixture? So, you know, you tell her, and I'll stay in the background on that one. So,
yeah. No, well, today, it's a good point, because if I were to say that, she would probably throw some type of Tupperware or something at me and tell me to do it her way. And I would need some kind of insurance, probably medical. And lucky for our listeners, that's what we're going to talk about today is insurance and the different types and the definitions and some of the terms that are used. So we're kind of rounding out and finalizing our personal finance topic. And insurance is a part of that discussion. You can't talk about personal finance without talking about the different types of insurance that you may need and how to budget for those and all that good stuff. So lay it on us, man. Insurance, what is it?
Right. Yep. And that's what's funny is because in your personal finance class that you didn't take in high school because they didn't offer it, and you may have taken it in college, but most likely not. You don't know what insurance is. You hear, oh, I'm going to get insurance through my work. Oh, the law requires me to get insurance for my car. Oh, insurance this, insurance that. There's various types, and how does it play a vital role in safeguarding your health, safeguarding your financial well-being, and by understanding and choosing the right insurance, the policies, you'll gain valuable insight in protection for you and also the risk tolerance. Now, insurance is there for the unexpected, right? Quite honestly, there's oftentimes you will go through months and months and maybe even years without even requiring to make a claim against that insurance. But it's a risk mitigation. Actually, it's a thing that you can do. The best definition that I've got is insurance is a type of contract that transfers the risk of something bad happening to an insurance company. So without insurance, you're at risk for coming up with the health, the impact to your financials or anything else. But if you buy insurance, you actually pay to transfer that risk to an insurance company, but you have to pay something for that, and that's typically called a premium. The insurance company then promises to help cover that risk of an event. Should it happen, they'll cover the unexpected event to the extent that your insurance policy allows.
And you just used a bunch of big words that people that are tuning in for the first time might not know. And we've got a bunch of episodes, even episode 21, 22, and 23. We talked about savers, spenders, balance, and investors. We talked about navigating financial risks. Is it worth a gamble? We talked about thinking ahead, embracing those risks with confidence. And you'll learn all about some of the terms that you just used by going back and rewatching some of those. But you make some great points in that insurance is vital, right? You can't, I mean, I guess you could go through life without it, but you're taking all of that risk onto yourself in that situation. And that's probably more than you want to take on.
Yeah, you're hedging against bad situations from happening. And yes, bad things do happen to good people. Maybe not severe and maybe not often, but in the event of a bad situation happening, it's always good to have that transfer policy or insurance policy. So let's talk about a couple of risks that may come up, like the financial risks that people and families face, like losing a job, getting sick, having something stolen, or the value of money changing. And when I say that, I mean like we're in today. My dollar doesn't buy me what it did 10 years ago.
You got dollar candy now instead of penny candy.
That's right.
Yeah, no, it does. It changes. And I won't go on another end the Fed diatribe, although it is still a valid point. But they do adjust our money, and inflation causes that to impact it. But also having something stolen, right? If someone steals something from you, oh, that's a risk.
Yeah.
I was actually just talking. We talked about on 2 episodes ago the big long motorcycle ride that I went on, and I was talking to some other motorcycle nerds. And my motorcycle has hard panniers. Those are those boxes on either side of the
Right.
back tire. And that's where I can keep all my stuff so that nothing happens to it. Well, some other guys had the soft panniers or the soft cases on the side. And he had it parked right outside a hotel. And someone walked up in the middle of the night, slit the bottom of his pannier, took all the junk out of it, and walked away. He
Really?
lost, it was like $2,000 worth of tools and technology. Like he had some iPad and a computer in there, and so yeah, risk. It's a part of life.
Can I ask you a follow-on question? Do you know if the guy was insured against theft on his motorcycle?
That's a great question. I did not ask that. I should go back and ask that question because that's
You
a
you, you
big game
should.
changer for him, right?
It could be because there's risk associated with things like that, and some risks have interrelationships, right? Like had this person come and stole something and then cut his fuel line or something like that, or if he needed to have that money or that iPad that was in there to be able to pay for his food the next trip or a hotel room at the next stop, it can be interrelated and it can kind of snowball. And so you can be protected by some of that, but some risks you can't be protected uh, at all, right? It's a good thing to be able to protect against some risks, but you're not going to be able to cover them all. You can't afford to cover them all.
So let's talk about this really quick. We'll run through 4 items here. Risk tolerance is really about how you want to live. Or, and let me say it another way, what risks you're willing to take. Maybe you're saying, oh, I'll just not partake in risky activities. And therefore you have a lower risk tolerance. Maybe for your motorcycle insurance, you're like, if it's 72 degrees and it's sunny and it's a Saturday and I'm going to go for a 20-minute ride, I need one type of insurance. If you're the
Yep.
crazy dude who's like, yeah, I'm going to drive from Texas to Florida, Florida to California, California back to Texas, and I'm going to do it, 4,600 miles in 8 days, you probably should
Whole
have
nother
a
ball game.
different type of insurance for that because there's a lot more risk involved. Additionally, your risk impact. How will you deal with those consequences? If you're going to drive 4,600 miles in 8 days, you better have the insurance where they're going to come pick up your carcass and get your bike on a trailer and put it to the next Honda dealership. If you get a flat tire, your engine goes out. That's a whole lot different than you having to work with Bubba and his pickup truck, and you got to move the deer that he hit over so you can fit your motorcycle. Like, this is a very different consequence situation you got to deal with.
So we
Third,
just lost all Yamaha listeners, and we also just lost all the PETA folks that don't particularly approve of hunting. You know what I mean?
Well, hunting with
That's
a
a risk.
vehicle, his truck was dented on the front corner. So, oh, it's so true,
Okay.
though. Yeah, it was a risk. Thirdly, you've
So
got risk mitigation, where you reduce them by being
yeah.
careful and planning ahead. And then fourth, your final option is transfer that risk to someone else. You get to stay in control of your money and make smart decisions.
Yep. And that's what we're all about today on today's show is transferring that risk to someone else. And that's really called insurance. Now, you can mitigate your insurance risk by not driving your motorcycle across the country. You own the levels of risk tolerance that you're willing to do. However, you need to be able to consider what risk tolerance do I have and at what point in time do I transfer that risk, how much of it, and how much am I willing to pay to transfer that risk. So how does insurance work? Let's kind of dig into that because the way I kind of look at insurance is bad things are not going to happen to everybody all at the same time. So if you pool your money and you have the many pay for the happenings to a few, that's kind of the definition of insurance. You spread the risk of financial loss among many, many people, whether that's health, whether that's automobile. You see hundreds of people a day driving, they don't get in a wreck. They pay insurance. You see the one guy get in a wreck, everybody's money will help to pay that transfer of risk to the insurance company and pay that off. I hope that made sense.
I think so. And the idea there, it's called one of two things. It's called either pooling or diversifying risk, spreading it out
Sure.
across multiple people.
What about an example?
Oh, we
We're
love
all
good examples.
Let's see. Do you have 7 examples that you could bring up?
Ah,
Kind of like the previous 2 podcasts ago, you had 7 and 7. That's 14. But give us an example.
well, here's the thing. With all of my crazy examples, it did make our episode quite long. So I'm not going to give 7 because we got to get through this thing. But imagine a group of 100 people who all
Right.
buy insurance policies. The chances or the odds that all of them will have a bad event happen at the same time is next to nothing. I mean, it's very, very low. Um, So insurance companies will use the money from everyone's premiums to pay for that one goober who just had to get to his Starbucks Frappuccino a half a second sooner and decided to cause a pileup on 635.
Right. But it helps him by paying everybody's money towards his dilemma or woes, but everybody is covered. Everybody is still covered just in case it happens to them. So, what do you think of insurance companies? What do you tell me that, because I got a few thoughts on that too.
So I've never actually confirmed this, but my fan theory is that Scrooge McDuck owns an insurance company because he is literally swimming in his gold doubloons, and insurance companies are very wealthy. Very, very wealthy. The masses pay for the few, and what happens to the insurance company? They make bank.
And the thing is, you always got the masses money coming in, but you rarely have the goober money going out. And so the insurance company actually is the one that benefits a lot, quite a bit. That's why you see insurance companies, Globe Life, owning a baseball stadium or managing that stadium. There's money to be involved in that. What I've always wondered is, if you have a policy and it's clearly spelled out and you have an event that they need to take the masses money to pay for your event, then why do they raise your insurance premiums after you claim an event? It happens, right?
Mm-hmm.
Because you think you would pay in, I've paid into insurance companies for 40 or 50 years now, right? And at some instances, if you have many claims or a few claims, they'll come back and say, well, you're high risk, your claim is changing. But it's like, I've certainly paid in more than I've extracted out of that. And I think 95%, I'd be a good thing to find that, what that percentage is that people pay. I know you're the millennial wizard on the Google search, but I think people pay in a lot more than they ever extract.
Let's find out.
And while you're digging into that, I want to go through a couple of definitions. The insured. Who is the insured? Well, that's you, the person who buys the insurance policy. And there's a lot of those, typically the masses that have that. The insurer. That's the insurance company that sells you a policy, and they can be pretty aggressive at selling you the policy, but then they agree to pay the covered losses. The agent. Who's the agent? Is it a secret agent or what? Because that's who you deal with. You rarely deal with the insurance company, but you deal with an agent who is the representative of the insurer and the insurance policy, or they may even work independently and search for you the best deal. And then there's the underwriter, which is one that we rarely get into understanding. And that's the person at the insurance company who actually sits down and calculates the odds about how much risk they're willing to take on and the price that they're going to charge for that premium. If you have bad driving habits and you've been in several accidents and you go to get insurance, the underwriter is the one that's going to set your fee for the risk that the insurance company is taking on to insure you. So those are just some of the key definitions of the insurance world.
All right. So I did find some information here. This is really interesting.
I figured it would be.
Okay. So first I found a funny way to talk about it, and then I'll get some of the percentages. Yes, the answer is yes. Most people do end up paying more in insurance premium than they ever extract in claims. Insurance. Yep. This is the example. Insurance is like buying a really expensive just-in-case smoothie that you hope you never have to actually drink. You're paying monthly for something you never want to use, like paying for a gym membership and then praying you'll never have to show up. It's basically a bet you're making with the insurance company. You're betting something terrible will happen, and they're betting it won't. The kicker, even if you win, say your car gets smashed by a meteor, the insurance company still only gives you enough to cover the repairs, while you've already forked over thousands in premiums. They're the casino, and spoiler alert, the house always wins. But hey, at least when nothing bad happens, you can enjoy that warm, fuzzy feeling of financial security, just without the part where you get any of your money back. Okay, so that's the funny part where they talk about it. Here's the numbers. It looks like studies suggest that the typical policyholder uses only 70 to 80% of what they paid in, which means that they're losing 20 to 30% on average over the life of their policies. 20 to 30% more than you end up using.
Oh, interesting.
That's higher than I actually expected it to be.
I would too. I thought it would be in the 10 or 20% that you get out from what you pay in.
Yep.
But then again, an automobile crash usually is quite a bit, but automobile premiums have skyrocketed. Oh my goodness, it's outrageous what it is. So we've talked a little bit about the. Do you have anything else more to add on the house rules? Because it's kind of like going to Vegas, right? They don't have all those glittery bright lights because the odds are in the gambler's favor. Um, that ought to be a that ought to be a podcast right there about gambling anonymous. So, well, we just lost all our gamblers. So, but then again, gambling in the stock market, and we talked about that. Are you an investor? Well, it's a gamble, right? There's one or two things that can go up or go down. But anyway, let's talk about some insurance terminology because there's a few very important terms that are used in insurance. Why don't you walk us through those?
All right, so the first one is premium. You hear this term a lot when you're signing up for the insurance. The premium, that's the amount the insured, that's how much you, the person getting
Right,
insurance, pays to the insurance company. So
right,
there's different ways you can pay that. You could pay it all up front. You could pay it month by month over usually a 6-month or a 12-month term, but that's the premium, how much you're paying in order to have insurance. Number two is the deductible. This is the amount that you must pay out of pocket before the insurance company will pay for a claim. So for instance, your car gets hit, you have to pay X amount, whatever that deductible number is. Maybe it's $500, maybe it's $1,000, but you pay that amount to the insurance company first. Then the insurance company will pay for anything over and above that based on how your insurance is set up.
right. In some instances, your deductible may be paid directly to the service provider, but the insurance won't pay their amount until they see that you've paid out your deductible. What about copays? That's another buzzword in the insurance industry.
Yeah, copay, a fixed amount the insured or you must pay each time you receive a service that is covered by your insurance policy. A great example of this is medical, right? The medical insurance is usually where you see this pop up because you go to the doctor for whatever and you have a copay. Maybe it's $25, maybe it's $50, maybe it's $100, but you're paying that to the doctor right there real time. And then the insurance will be paying the rest of your visit and the costs associated with it. Again, depending on what type of insurance you have. But you have to pay that no
Right.
matter what, just for showing up.
Then there's a couple other things. The policy limit, it's not, the sky is the limit. There's typically a limit that they'll require you to pay your premium to get to this threshold and then no more, right? It's a policy limit. Claim is when you actually call the insurance company and said, "Hey buddy, I transferred my risk to you. Now it's time to cough up." That would be an event that you would file with the insurance company for them to satisfy that requirement or to cover that loss. And then the last thing is the benefit, the amount of money the insurance company agrees to pay when you make a claim. And there's a lot of things tied to that. It could be the limits that you won't go, the policy limit, and also after a copay or things like that. But that limit, the benefit, is what they're willing to pay out.
Okay, so that's helpful. I think we've got a good idea now of the kind of some of the big keywords that you should be thinking about when you're setting up your insurance. Can you give us an example of how insurance terms are used? When you see it, when you're signing up for it, what does it all look like together?
Sure. So home insurance is probably a very, very good example that you can use. Say you have a policy that has a policy limit of $400,000. That means the insurance company is not going to pay out any more than $400,000 worth of policy claims. So there's your limit right there. And say you have a fire and it destroys your house, they'd be willing to pay up to 400,000. Now, typically they'll pay whatever the minimum amount to replace your living dwelling to get you back going, but it's going to have a policy limit of 400,000. Another is health insurance. A policy might have a copay for $30 for special visits. You go see a specialist and say, "Hey, I've got this problem." He comes back and says, "Oh, your copay is $30." That's the amount the insurance company wants you to fork over first before it will become effective on your policy. So they may pay a portion of the claim.
All right. Then you also would have a car insurance policy that has a
Yep.
deductible of $500. And that's where you get in an accident, your car is damaged, you have to pay the first 500 out of pocket. And then after that, the insurance company steps in and pays the rest.
Right.
And then finally, a life insurance policy might have a premium of $300 per year. So you're paying $300 per year to keep this life insurance policy. And if you don't pay that $300, your policy is no longer active.
So that's a broad kind of explanation of insurance. It's a good thing to have. You want to transfer that risk to someone else. Some of it is required by law. Let me tell you, if you buy something through a loan, and here we're going back an episode or so, if you buy something through credit or through a loan, that person or financial institution that gave you the money for that loan will require that you have insurance. Two examples. One is a car. They want to make sure that they get paid back because that car is their collateral to go pick up and say, "Sorry, you defaulted on your loan. I'm going to take the car." Well, if you get in a wreck and it destroys that car, then they have no recourse back to collect their money. So they're going to require that you get insurance. The same thing with the house. And you're going to have house insurance for years and years and years to come to the extent of the terms of your loan. And they want to make sure that that asset that they gave you the money for, they can collect on that. And if there's something that happens with a fire or something else, they're not going to be taking any of the risk. They're going to require that you have insurance, transfer that risk to the insurance company to be able to fulfill the fixing up that house so they could get their money back one way or another. I hope that makes sense too. So,
Well, it brings up a really good question. I wonder if you have the answer to this. Why don't insurance companies ever play hide and seek?
I'm not sure why.
Because good luck hiding. They're always going to find you when it's time to collect those premiums. But it seems like they disappear every time you need to make a claim.
I often tell you that the Bigfoot is the champion hide and seek player. I got another one, the Loch Ness. For those of you that aren't watching on the YouTube, Chase has a Bigfoot T-shirt on with a hockey stick, and I can only imagine.
He's got skates on too. He's a
He's got
hockey
skates
playing
on.
Yeti.
That's
What
right.
can I say?
That's right. A Yeti. The other thing is the second place is the Loch Ness monster, because if you really think of it, with all the technology that we have and the sonar and everything else, we should be able to score big time picks of the Loch Ness monster. But he's the second place of the. And now we lost all of the Bigfoot followers and the Loch Ness monster followers. But anyway, yeah, insurance companies. There's a place for them. I'll call them a necessary evil because they take your money, but you better finance for that to transfer the risk of your existence. So.
Yeah. And we actually did an episode about, I don't know, 10, 15 episodes ago where we talked about the different types of insurance that you need. Because there are, I would say, using some of the verbiage from last time, there are predatory insurance companies out there trying to sell you things that you don't need. But
Right,
there are
exactly.
a handful that you do need. And so if you want that list, go back and check out one of our earlier episodes during this personal finance
Good.
thing.
You can I hope learn from us, and on times, Chase, you and I agree, but we always end a podcast with a certain saying, and it's so true even in the insurance industry. Just because it's different
Doesn't mean it's wrong.
Have a great day. I'm looking forward to the next episode.
See you soon.